makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Yemen's Houthi rebels say they'll continue attacking ships in the Red Sea despite the U.S. moving to protect the vital trade route between Europe and Asia. Meanwhile, right here in Europe, the EU striking a deal on new rules on debt and spending after months of wrangling. We're going to discuss what it means for the entire bloc. Plus, in the corporate space, Toyota shares slumping the most in 18 months after it's hit by a million-car recall in the United States and raids on its Japanese offices all over a safety scandal. Now let's get a quick check on the European markets map here because, look, a lot is trading. A lot is happening in a very, very thin holiday volume anyway. So you are going to see a sea of red. But look, don't panic. This is not a negative market narrative, not just yet, because we are seeing a very thin trading volume. So every single move is, at the end of the day, magnified. You are seeing a little bit of underperformance over in Germany here, down by about 0.3% on the DAX, but the rest is still on the red. A lot of that digesting perhaps some of the market sentiment from overnight in the U.S. session. By comparison, futures are actually in the green. But I want to get a little bit more context on the markets here because there is a lot to digest, especially when we talk about some of the moves that you are seeing from the monetary policy, the geopolitics as well. A lot is going to be happening in terms of simply the quantitative tightening procedure as well. And again, all that are themes going into 2024. Now, I want to get a little bit more on the market narrative because there's a lot going on. I want to speak to Charlotte Ryland. She joins me right here on set from CCLA Investment Management. We are thrilled to have you this morning. Happy holidays.
Happy holidays.
Very cheery, clearly. Let's talk about this market move here. We were fully expected for a Santa rally, but just judging on your outfit, it feels like you might have called the Santa rally absolute chaos earlier. Walk us through it.
I think, to be honest, as you said, it's like we're 4 days till Christmas. You know, volumes are incredibly thin in the market, so I don't think we should be reading very much into what's been happening. I think it was, there was some talk about options and things going on yesterday, so I don't think there's a lot going on there. But, I think clearly markets have moved a long way. I mean, 15% rally in the S&P since the end of October. Quite a lot being priced in at this point. So I think there's quite a lot of big questions as we move into next year about can we continue as we move into January in this optimistic frame.
Well, it feels like a lot of the green on the screen that we've seen lately, the 15% rally. Yes, some of it came from the AI and the Magnificent Seven, and we'll leave that narrative to the side. But let's talk macro for a second. If we're talking about a rate cut and a big chunk of that basis being on an insurance rate cut, we're going to get that fixed for you in just a second. But a big piece of the equation is also going to be in terms of how actually you see some of these rate cuts really priced into the market. Is that some sort of sign that actually this economy needs a lot of help? Or is this a sign that, well, actually, the Fed has your back, the era of easy money will make some sort of return? Yeah,
I think probably a bit of a scepticism on this idea that, having zero interest rates is a normal set of occurrences for markets. Actually, we'd say, where you should be is probably much higher than what we've been used to in the past. We would say that inflation, yes, it's been coming down pretty dramatically this year, and the base effects have helped with that. The big fallback in things like energy prices in Europe have helped with that. But as we move into next year, things like core inflation are still pretty high. The UK is still above 5%. Wage inflation is still pretty tight in the UK. We've got a minimum wage coming through in April. And the economy still looks has been much stronger than people expected. So I think to assume that inflation has disappeared, I think is a difficult thing. And therefore, that's why we'd say, yes, central banks probably got to this peak at interest rates, but to assume we have lots of cuts in interest rates without actually having a recession at the same time, probably more difficult. If we have a recession, clearly that's not great for markets.
Especially in an election year, I might add, in 2024 over in the United States. But then let's bring it back to the inflationary story, because I'm so glad you said that. I feel like sometimes I'm the only one saying, well, inflation isn't over just yet. And we actually saw pieces of it with the commodity story. Of course, we know a lot of the inflation data isn't commodity driven at the moment. But now that we're talking about shipping concerns, geopolitics, specifically in the Middle East, that are starting to have a much longer time frame than initially thought, do you think the commodity inflation could be a concern going into 2024?
And I suppose the thing with the oil price is that what we've seen is that the US is now, a very huge producer. They're producing more than they ever have done before. The efficiency of the wells that they're drilling has improved dramatically. And so OPEC is no longer the people driving the oil price. They've tried a couple of times this year to try and push up the oil price. They haven't had a great deal of success. So, and if you add into that, the long-term picture is for demand to fall because as we move to that low-carbon economy, that's going to continue. So, and a slightly weaker economy. So we're not really expecting a great deal from the oil price. Yes, there could be some volatility. Yes, geopolitics can play into that. The Red Sea at the moment is part of that. But we wouldn't expect this to be another surge in commodity prices next year.
So let's just bring them back then to the trade that we're talking about. We'll forget the Santa rally for a second. I'll even give a pass to perhaps the January seasonality that we might see in place. But talk to us a little about positioning here, because for a very long time, there were longs and shorts in this market that really didn't make a lot of sense. I'm going cross-asset here when you have a lot of the smart money really parked on one end of the bond market curve, kind of diluting, and I want to say distorting the curve to some extent based on what Fed swaps are pricing in. On the other hand, if you look at, say, the FX market, for example, dollar longs having kind of creating dislocations in the U.S. equity market, and I would argue the European market as well. What is the dislocation?
I think clearly you've had a market which has been dominated by the Magnificent Seven. That was much more story in the first half than it was in the second. We have seen market breadth improve. There was a logic behind that because the Magnificent Seven were discounted a great deal in 2022. They were on track to valuations. They produced these pretty good earnings numbers. They found that actually they could cut costs when they needed to.
Yeah.
The economy held up better in terms of things like advertising rates, and that helped people like Amazon and Alphabet as well. Now we're saying, these stocks have re-rated. They're no longer looking desperately attractive in terms of that. Do I think their earnings are going to collapse? No, I don't think there's any evidence of that. But could they just sort of slowly trickle along next year and not be the things that lead? Quite possibly. And so you are going to have to look for other areas of the market to pick up that leadership. But
do you need breadth then? When we're talking from a macro perspective, do we still really need breadth, given that, as you pointed out, some of these big tech companies, the Magnificent Seven, are at the end of the day equally exposed to the day-to-day eco story, the advertising revenue, for example. That is ultimately a cyclical funding source, as opposed to kind of being this stereotypical defensive trade. Is having sole tech leadership such a bad thing?
Well, I think, these companies are now so big and they've been playing these sort of trends, the shift away from traditional advertising into digital advertising. A lot of that trend has already happened. You could talk about cloud computing. We think that's probably a much earlier stage, and therefore that's going to be a bigger driver for people like Microsoft and Amazon through its AWS. But a lot of those trends are more mature now, so these companies therefore become much more sensitive to what's actually going on in the underlying economy.
It's interesting when we're talking about the underlying economy then, which brings me back to, again, the sources of where we could actually see inflation. We're talking about commodity inflation, labor market kind of came in there as well, but Bloomberg Economics very aptly put the idea that you don't actually need rate cuts to align with what the labor market needs. In fact, if you look at history, rate cuts have actually come before the labor market indicated any need of that. At the same time, wages are still rising. They are still very sticky, specifically right here in the UK as well. Is the pain point of inflation in 2024 on the wages side?
I think it depends which market you're in. Certainly the UK has a structural issue in terms of we've had Brexit and that's disrupted migration flows. We have a population in which participation rates have never really recovered properly from the pandemic, and we could perhaps look into the health system and what's been going on there as a pointer to that. So, and you have an ageing demographic as well. So, all of those factors are sort of playing into something which is a little bit more structural than just the cyclical.
Yeah, a lot to digest, of course, on both the macro and the micro front. Charlotte Ryland from CCLA Investment Management joining us this morning to walk us through that macro narrative as we end up the year. And, of course, it is just the macro story. There's plenty of micro as well. She was talking a little bit about the tech space, but I want to put a few other corporate stories on your radar, specifically in the last 24 hours, coming from the world's largest car maker, Toyota. Shares slumping the most in 18 months in Japan after its subsidiary saw its Osaka offices raided over a safety probe. Both companies saying they were cooperating with officials, and this just one day after Toyota recalled about 1 million cars in the United States due to a possible airbag glitch. Now, more kind of pre-market stories where you want to watch, not in Asia, but this time looking forward to the U.S. session. Micron higher by 6% over in the pre-market trading. A lot of this coming off a very strong forecast. Remember, Micron had a lot to deliver, and they certainly did, by saying that a lot of that AI demand from data centers, well, that's where their next leg of revenue is going to come from. A much stronger forecast than the markets expected. It's not just the tech space. Media, of course, getting a lot of attention as well. A historic deal in the media space on our radar. Warner Brothers and Paramount reported to have had a merger. Look, it was rumored that the Redstones would actually want to at some point sell Paramount, so this merger might be a solution, but it essentially puts a lot of streaming networks and cable networks all under one roof. Marginal gains there for both companies. Of course, that is going to be your broader picture when it comes to the equity market. Coming up, we go into the geopolitics. Yemen's Houthi rebels say they will continue attacking ships in the Red Sea. We'll bring you the latest update out of the Middle East next. This is Bloomberg. U.S. Secretary of State Anthony Blinken says Israel needs to shift from large-scale military attacks to more targeted operations in Gaza. Meanwhile, Houthi rebels have vowed to continue targeting ships in the Red Sea in support of Hamas. Now, the Iran-backed group also warned that will retaliate if the U.S. attacks Houthi bases. Joining me now is Bloomberg's Al Nightingale, walking us through the dynamics here. How likely is it that this task force actually does what it's meant to do, given that the Red Sea already has 2 U.S. Navy vessels in the region? How much more is there to do?
Well, that's a great question. If you listen to the national security spokesman earlier this week, he talked about maritime surveillance and taking defensive action. And the proof of the pudding will be in the eating. We won't know until this task force has been up and running just how effective it's going to be. We still need details. It doesn't sound like the plan is completely set in stone yet. So it's only when that happens that we're going to have a real clear idea, and that the shipping companies start to get comfort about, how effective it's going to be.
What's the time frame here, though? I mean, Bloomberg Economics, for example, put out some great analysis saying that it's going to be somewhere in the realm of 3 months when you start to see Red Sea tensions normalize. But if you were to square that with some of what the geopolitical strategists are saying in terms of the Israel-Hamas conflict altogether, which, of course, this is a function of, some people are saying years. Give us a time frame here.
That's such a difficult question, and it's a question on many levels. First of all, you have the security situation and how quickly that can be resolved. That very first step of it is not clear, because you need to know just how effective the plan is going to be, how effective those convoys, probably convoys, are going to be. What kind of convoys are they going to be? Will the Houthis, just fire missiles out from shore? These ships, will they all be intercepted? There's loads of questions. So that's the very first part. Then you've got the ships that are being disrupted, going the long way round, arriving when they weren't expected to arrive, getting back to Asia for their next cargoes when they weren't expected to be, getting back to Asia at different times. It's going to take a long time. So there are many aspects to this, and in a broader sense, yes, there are these huge geopolitical questions that go well beyond the immediate response.
So let's talk about the reaction to it. And I'm not necessarily talking about the markets, but specifically the shipping market. When we're talking about rates here, it feels like this is a good time for this kind of crisis to happen, just given the excess shipping capacity. But I think something that's confusing me here is that if so many people are looking to reroute around Africa, I think it's a 40% increase in distance itself. Why are the costs in terms of staffing, in terms of fuel, in terms of even distance, why are those not being, or at least showing up in other places?
To start with, I think if you look at the shares of shipping companies, we looked at a big index yesterday and the market caps of all those firms. That's gone up by 22 billion, to around about 190 billion as of yesterday, and maybe the numbers have moved around a little bit since. But you can see that investors clearly think that this is going to have an effect on freight rates and going to be beneficial to the bottom lines of a lot of shipping companies. So it's happened at an opportune time. Opportune is a horrible word, but it's happened at a time that is helpful to the container shipping companies in particular, which have had issues with capacity. It's going to take a while to resolve. Rates will go higher for those guys, and I think you will see it in a lot of areas. Not in everything. Shipping is always a mishmash of responses. It's not like all rates for all kinds of ships go up, because they all have their own dynamics that go alongside any one issue.
A mishmash. I think that's the right way to describe this situation. Bloomberg's Al Nightingale, we thank you so much for joining us this morning and bringing us that update on what is going to ultimately be a truly global trade story. And of course, as we explore that theme in the next couple of months, we still have to think about the fiscal repercussions, which brings me to right here on the European narrative. European Union finance chiefs have now ended months of wrangling to agree on new rules with a gradual path to cut debt. Now, the new rules will define the bloc's ability to invest in key sectors like defense. For example, Spain's finance minister Nadia Calvino, however, expressing a little bit of optimism around the new deal. Take a listen.
The rules are more realistic. They respond to the post-pandemic reality, and they incorporate also the lessons learned from the great financial crisis. And I think that from this point of view, there is increased ownership and there is increased understanding of the implications of the rules and the necessity to ensure that there is enforcement of these rules.
Now, for more on this, Alessandra Migliaccio joins me from Rome. Alessandra, a month of will they, won't they? Why does this change the game in terms of what they finally agreed to?
Right. So, yes, months and then finally actually only just 2 hours in their final conference call. But of course, there were weeks and weeks right before the call, but they were still arguing. The Italians weren't ready. The Germans wanted more austerity, et cetera, et cetera. In the end, they agreed on a deal that sort of makes everyone happy and unhappy at the same time. You know, countries with very high debt over 90%, will have to trim it by 1 percentage point of GDP during something that they're going to call adjustment period every year. That's quite a lot. They've agreed, on the other hand, that they, however, will give leeway, will give more time to do this to countries that invest in things like defense and things like clean energy, so that it's not a complete austerity type of program plan. What stays the same? What stays the same is the threshold, 3% for GDP, for deficit, and 60% for debt. But then there are all these very complex rules around it, so we're not sure exactly how it will work. But at least, look, the good news is we do have a deal.
I mean, Alessandra, I don't mean to be the Grinch in this holiday season, but let me just throw a little cold water on this. There are already concerns about whether some of these economies, specifically in the periphery of Europe, were able to meet the original fiscal rules. So if we're comparing in some ways this to some realm of austerity or something tighter to get ahead of some of the debt concerns, why is there any confidence in the fact that we might actually hit the new rules when the old ones were still in question?
Absolutely. You're 100% correct. This is a very complex deal. There's all kinds of criteria that you have to respect and different periods, different adjustment periods. And yes, they were not respecting the old stability pact. So what will happen now, we're not sure. Countries like Italy, of course, they weren't even sure about this. At some point, they even said, let's just go back to the old pact. The hawks, the way we can term them, the hawks are saying, well, because there are so many details, actually, this is a way to keep countries sort of on the straight and narrow path, because they'll have to respect certain criteria, each period. They'll be reviewed often. Will it work? Will it not work? Hard to say. I have some doubts. Analysts we spoke to have some doubts. You have some doubts. So we'll see. The Italian finance minister, at the end of the meeting yesterday said, we're glad we have a deal. It's positive, but we'll have to see in reality.
I mean, we all have some doubts, there's no doubt about it. But to put my optimistic Santa hat on and trade it out for the Grinch one, there have been economies that have surprised us to the upside. Italy, for example, and Giorgia Meloni's plans have in a lot of ways surprised the consensus that were pretty negative going into her reign. And yet here we are. Bloomberg's Alessandra Migliaccio, we thank you so much for that crucial context this morning on what is expected to be, again, major repercussions for global European markets, and specifically the bond market as well, which brings us to the key themes for European banks in 2024. We're going to dive into that next. Feet first. Stick with us. This is Bloomberg. Welcome back to the Pulse. I'm Kriti Gupta in London. Banks in Europe have been boosted by soaring interest rates from the world's monetary policy. But as rates peak, the debate has shifted to when cuts will actually get underway and what the repercussions are for the industry. For more on this, I'm joined now by Philip Richards, joining us from Bloomberg Intelligence. Philip, a little bit of a positive track record for banks around the world. Net interest income really working in their favor, but for how long?
Yeah, thank you. And that's definitely the key question. I mean, 3 months ago, we were looking at maybe 1 or 2 base rate cuts across Europe over the next 12 months. But with inflation now coming under control, it looks like we could have many, many more cuts than that. And the impact of that, of course, is therefore more a squeeze on bank margins, and therefore revenues coming under pressure. And that comes at the same time if we are going into an economic slowdown, it could be slower loan growth as well. So a double hit for the banks there.
So is the change in interest rates the only thing that's kind of propping up some of these banks? If you look at even their loan book, as you pointed out, if you look at some of their deal flow, things aren't working in their favor. So is essentially this monetary policy the only thing keeping it afloat?
No, the other good thing is in terms of credit quality, in terms of the bad debts of the banks, which have been remarkably low. But that's partly because of the big buffers they built up during the pandemic. But of course, if they run those out and increasingly use them up, then we go back to the real world and they won't have that offset. So say economic slowdown, we've got higher rates, charges could start moving higher as well. So yes, banks will be hit on both sides, revenues and credit quality.
It's a really tough situation that a lot of these European banks are in. I'm very curious to see how it all shakes out. Philip Richards from Bloomberg Intelligence, we thank you so much for that crucial context. Now, coming up, the European banks, some of the European central banks, traders ramping up BOE rate cut bets in the back of that softer inflation yesterday. We're diving into it. This is Bloomberg.